This is a different economy in 2025. It's the post-COVID economy. This is a completely different labor market than anything we've ever seen before. And the end of globalization. Prices have more friction and they stay much higher. Prior to the last 10 years, there wasn't such a thing as negative interest rates or money printing or anything like that. The point I'm trying to say is that was a unique experiment in human history that we did one time in 5,000 years. It's over. The U.S. government will always find funding. You just might not like the interest rate that they have to fund it at. They'll just keep lowering the price and raising the interest rate to basically suck money out of every other investment, or as I like to say, suck the life out of the stock market if it has to.
If we're in this environment for the longer haul, what will be the big impact on investors that they aren't pricing in yet?
We're going to create new industries and new jobs, and there's going to be more than 8 million of them that are going to be created.
Before we get started, this isn't financial advice. Know your risk tolerance, do your own due diligence, and speak to a financial advisor. All right, welcome back to another pod. These days, it kind of seems like most of Wall Street is still kind of betting on rate cuts, pricing in a pivot that just never quite arrives from the Fed. But what if higher for longer isn't just a detour, but the new roadmap? That's the question Jim Bianco has been pressing for months. Founder and macro strategist of Bianco Research, Jim has spent 3 decades challenging consensus takes, charting flows, policy, and economic cross currents long before they splash across many of our news feeds. And Jim isn't buying the imminent Fed rate cut that I think many investors seem to be praying for, and neither does the data he tracks. So today we'll dig into why the Fed might keep its foot on the brake, how that reshapes everything from bond math to equity risk taking, and where perhaps the real blind spots in this market may be. So Jim, welcome to the pod. Thanks for joining me.
Thanks for having me. Looking forward to the conversation.
Appreciate it. So let's jump right into it. You've been pretty clear that you believe the Fed pivot isn't coming, at least not soon. You know, why is that, and what do you think many in the market are missing?
Yeah, it's not only me that doesn't think the Fed's pivot is coming soon, depending on what you define as soon, but neither does the market. It is priced, you know, you can look at the Fed fund futures to give you a probability of where the Fed's going to move. And it's well less than 50% for both the June 18th FOMC meeting and July 30th FOMC meetings. So now you're off into September 17th, and it's only giving you about a 55% chance as of when we were recording that there would even be a rate cut at that meeting. So the market is of that opinion too. Now, what is it that everybody's missing? I'll give you a big picture answer. The cycle of disinflation, that we could never get inflation above 2%, we could go to zero on interest rates and print money, that era ended with COVID in 2020. It's over. That's the previous cycle. We are now in a cycle of higher inflation, stickier inflation, higher interest rates. And that's really the reality that we live in now. So all of those that are demanding the Fed cut and look at inflation is down, it's at a 4-year low, although it's higher than anything we saw in the 2010s, you know, is pining for the last cycle. I think that what we need to understand is that the cycle turned in 2020 with COVID, and that we're in an era of stickier inflation. And it isn't good enough. Oh, we got a couple down months in inflation. Good enough. We're not going to have any more inflation. Cut rates. No, it has to go down and stay down for years before we can actually entertain the idea of much lower interest rates and Fed cuts. I'd even go you one step further. That when the Fed cut rates in September, the 10-year yield was at 360 on September 18th, the day they cut rates. It went by then to January to 480, up 1.2% in 4 months. And the Fed cut rates 100 basis points, 50 basis points in September, November 25 basis points, December 25 basis points. That is the worst reaction we've seen in long-term yields to a rate cut cycle in over 40 years. That usually when the Fed cuts rates, long-term rates go down, they don't go straight up. Why'd they go straight up? My interpretation, I know the Fed hates this one, is the market was rejecting the rate cuts. It was saying you need to be vigilant about inflation. You're not being vigilant about inflation by cutting rates in September, November, and December. And therefore, I'm not interested in owning your 10-year and 30-year bonds. And that's why the yields went straight up. So that's kind of the take I would have with that.
So you talk a lot about the structural cycle. Can you kind of break down what that means, like prior to COVID, contrast it with today? And does this mean we're in like a new monetary regime long term?
Yeah, I think we are in a new regime. I think we're in a new regime on a couple of levels. On level one, I think that the cycle changed towards more inflation. Sticking with the bigger picture and then writing it narrower. I like to say that every time you have a recession or a financial crisis, and we had both in 2020, the economy changes. Change is not worse. It's not dystopian. It's different. This is a different economy in 2025. It's the post-COVID economy than it was in 2019. And if you want two examples, one is remote work. Something like 6% of the workforce in the United States was working remotely. Remotely is more than one day a week you get paid to do your job, not in a central location. So not in an office, not at a hospital, not at a site, not at a store. 6% of the workforce was getting paid remotely. Today, it's 25% of the workforce. So this is a completely different labor market than anything we've ever seen before. And the end of globalization. Now, the new word to me that I've heard is now they're calling it segmentation. So we're going from a globalization to a segmentation. And because of that, we're starting to see the economy start to change in ways that we don't understand. And one of the things I think has been that prices have more friction and they stay much higher. Now, on the shorter term, I think what we're really starting to realize on the shorter term is there's the potential of higher prices because of tariffs. That could also push up the inflation rate, or at a minimum, not make it go down anymore. I think it'll push it up, but even at a minimum, not make it go down anymore. And these realities need to be understood. I think Jay Powell has been very clear, and these are my words to explain what he was saying. You guys over here are talking about whether or not we're going to have a recession, quoting the poly market odds, whether or not we're going to have higher employment. And I'm over here, Jay Powell, looking at prices. And call me when the labor market is bad. Not it might be bad. Not that you got 1 week of a worrisome continuing claims number. I want number after number and anecdote after anecdote that the labor market is bad. Then I'll consider cutting rates. Right. Until then, we ain't going anywhere because we're more worried about prices. That is not understood on Wall Street. Wall Street thinks prices, schmices. Forget those. And you'll see people just talk about there's going to be a wobble in the labor market and the Fed has to immediately cut to stop a recession. They didn't in 22. In 2022, the first quarter was negative GDP and the inflation rate was on the way to 9%. What did they do in the face of that weakening economy? They were raising rates 75 basis points a meeting. Now, I don't think they should be raising rates 75 basis points a meeting, but we had a negative first quarter this year. And their response is, we're not going to do anything. So I think that a lot of Wall Street is not appreciating prices. They're still pushing this narrative that AI and technology is going to keep pushing inflation down. Look, that's a 35-year-old story, which I think ended in 2020. And I'm also, the last thing I mentioned about inflation is, I'm thinking about inflation in terms of 3 to 4%. The other mistake everybody says is when you say, look, I'm worried about inflation, they immediately say, Zimbabwe, you're thinking about 1,000,000% inflation. No. I'm not saying that it's going to be out of control. I'm saying it's going to be 3 to 4 as opposed to under 2. What does 3 to 4 mean? The current yield on the 30-year bond as we're recording right now is exactly 5%. That's a normal yield. That's what you should expect. That is right exactly where it should be. But most people think that it's too high. And we're writing all these stories about why is it up? And is it because too much budget, too much borrowing? There's something wrong that we have a 5-year, 30-year. No, there's nothing wrong. That's where it should be. When it gets to that level that is wrong, it's going to be much higher in yield than it is right now.
I think why investors are spooked is because they see all this U.S. government debt rolling over this year, right? And so with the Treasury spiking, it's creating this kind of I guess, anxiety. But if you take, so are you saying that essentially the key barometer for the Fed on what to do with interest rates is more related to employment?
No, I think it's more related to prices, less related to, I'm saying Wall Street thinks it's more related to employment. I think it's more related to prices. And I think that what's prices is inflation. And I think that most people just, like I said, forget inflation. It's not a problem. It's going away. And they still actually argue, too, at the same time that don't worry, on the next downturn, the Fed's going to cut rates to zero and they're going to print money like they did between 2010 and 2020. Quick word on that. Sidney Homer, Richard Sala wrote a book. Sidney Homer wrote it, the first edition in the 1950s, called History of Interest Rates. And it actually tracks interest rates back to 3000 BC. We actually do have data on that going back, 5,000 years.
I'd love to read that. What was the name of the book?
History of Interest Rates by Richard Sala and Sidney Homer. The last edition of it is the fourth edition. It was 2005. It's on my bookshelf right behind me, right there. It's mainly a lot of tables and explanations about, long-term look at interest rates. And in that book, there is not one syllable. It's 700 pages. There's not one syllable about negative interest rates, money printing, even zero interest rates. Gets no play. Because prior to the last 10 years, there wasn't such a thing as negative interest rates or money printing or anything like that. The point I'm trying to say is that was a unique experiment in human history that we did one time in 5,000 years. It's over. It might be 5,000 years again before we see negative interest rates on a broad scale one more time. But everybody keeps acting like, no, it's going to be the next downturn, which starts later this year, that the Fed is going to cut rates and do that again. That, what I'm trying to say is, you want to know what was the extreme period that is not repeatable? 2010 to 2020, when we had negative interest rates and money printing. It is not 5% interest rates today or big term premiums today. That's actually pretty close to being normal. It's that period before that everybody wants to return to. That was the extreme period that we're probably never going to see again.
See that how does the U.S. manage its debt then?
Well, see, this is the problem. There's an old saying on Wall Street, and you said people are worried about the debt, and they should be. It is a problem. But there's an old saying on Wall Street, there are no bad bonds, there's only bad prices. And, will the U.S. fund, is there a maturity wall coming? Yes. And is there big borrowing coming as we understand the bill now? Now, maybe, the Senate version and reconciliation might change the big, beautiful bill into less spending, maybe. But right now, as we understand it, there's going to be a lot. So how does that get funded? Oh, it'll get funded. The U.S. Treasury, the U.S. government will always find funding. You just might not like the interest rate that they have to fund it at. They'll just keep lowering the price and raising the interest rate to basically suck money out of every other investment, or as I like to say, suck the life out of the stock market if it has to. Because the bond market, if you look at capital structures, bonds go first. They get paid first. They will get funded first. All right, no one wants to buy bonds because they're all worried about this. All right, I'll try 6% yield. Well, they still don't want bonds. I'll try 7% yield. I'll keep going till you find the yield that you say, the hell with the Mag 7. They suck. I want in on these treasuries. What is that yield? Some people say to me, well, that's not till 20%. I was like, be careful what you wish for, because it'll wind up wrecking the economy at the same time. So the bond market will always get funded. That's my point. It will always find money. You just might not like the damage it will do to everything else to get that money. And that damage is higher interest rates, lower discount rates, poor valuations, because you have to measure like PE ratios against interest rates and the like. So the bond market will always get there. So yeah, be worried about the deficit. It is a problem. But what I'm trying to argue is it is a problem. It's not the 5% yield we see today. That's not the problem. It's a much higher yield that might be coming in the future that is going to be the problem.
Jeez. So if we are in a higher rate environment or a more normalized rate, or perhaps going higher from even here, if we're in this environment for the longer haul, what will be the big impact on investors that they aren't pricing in yet, whether in equities, housing, or credit? Sounds pretty bearish.
Yeah, it's bearish to a point. It's about valuation. if you look at the forward PEs, Wall Street's favorite metric on stocks, the forward PE, right? What is the estimate for next year's earnings divided by the current price? If you go back to, February when the stock market peaked, it was in the low 20s. And that's pretty high. It's not the highest it's ever been. That was 1999 in the high 20s, but it's very high. So what does it mean to buy what does it mean to buy not an overvalued market, but a fully valued market? You're betting on a lot of things to go right. One of those things you're betting on going right is that the relative valuation of all the other markets makes stocks look attractive. Yes, I'm paying up for stocks at a 19 or 20 forward PE. I'm betting that those earnings estimates will come through and those companies will actually earn that in the next year. But I'm also betting that you don't want to touch bonds, you don't want to touch cash or gold or anything else because all of those markets have so much lower expected returns that we coined a term for it in 2019, Tina, there is no alternative, and that you have to be in stocks. So as interest rates go up, it makes cash more attractive relative to stocks, bonds more attractive relative to stocks. So I've termed this over the next several years, the 4, 5, 6 markets. 4% is what I think, not 2025, but over the next several years, I think cash, if you own T-bills or money market fund, you're going to get 4%. If you own bonds, a bond fund or something like that, you're going to get 5. In stocks, I think they're going to give you 6 because of those high valuations and higher interest rates. In fact, Bob Shiller of Yale University has done a lot of work on, asset valuation. He won the Nobel Prize in 2013 for his asset valuation model. Most of us know it as the CAPE ratio, the cyclically adjusted PE ratio that he does. And it says that at these valuations and at these levels of interest rates, you should expect the stock market to return you about 1% more than the bond market. Now, if I think inflation is going to be 3, 4, 5, 6 is not awful. It's just not the 20% that we've all been accustomed to. And so the other thing I've been trying to say is you have to dial back your expectations. As a macro guy, everybody asks me the same question, and I'll tell you what they're really asking me. When's it going to go up 20%? Is basically what they're asking me. I was like, well, the answer is 23 and 24. And you already had your opportunities at 20% gains. I don't think you're going to have your opportunities at 20% gains going forward from here. I think it's going to be more like 6. And so we need to adjust our options. Now, maybe you could pick a stock or a sector or a theme that'll do better than that. Maybe not. But what most people want to know is, I want to be dumb money. I just want to own the S&P, and I want it to go up 20%. Yeah. I don't want to have to get, expend brain cells trying to pick stock A or theme B relative to just buying the whole index. The problem is, at high valuations, great uncertainty, and with higher interest rates, there's a lot of headwinds for the stock market. I did not say that that's going to be a massive bear market and horrible pain and everything else. It's not going to be that. Quick word about bear markets. I view them differently than I think a lot of people do. I've always said, look, people will say to me, the stock market always rebounds. Every time it sells off, it always rebounds and makes a new high. Correct. So a bear market is time. It's not price. So the question is, February 19th was the peak in the stock market, a little over 6,100 on the S&P. When are we going to make a new high? Is it going to be like 2020 when it took 5 months to make a new all-time high? Or is it going to be like 2000 when it took 13 years to make a new all-time high? So that's really the question. How long is it going to take before will we make a new all-time high? How long is it going to take before we get an all-time high? Where does that question matter? Most of the money is owned by boomers over the age of 60 right now. If you tell somebody who's, say, pick a number, 65, okay, it might be 13 years before the stock market makes a new all-time high. Unacceptable. I only have 15 or 18 years of life expectancy. I don't want to spend 3/4 of it just to get back to my net worth of 2 months ago. If you tell somebody who's 35, it might be 13 years before it makes a new all-time high. Great. I could spend the next 13 years dollar cost averaging in for the next 20-year run. So that gets into this whole idea of where you are in the cycle and what your risk tolerances are. If you're older, your risk tolerances shouldn't be as aggressive because you don't have enough time to work out the issue. Besides, if you're 70 years old, that is your net worth is 70. Yeah. You're not trying to create net worth. You should be investing to not lose it, which is being in the bond market. If you're 35 years old, you should be investing to create net worth. And so that's why this becomes an important issue for where you are in the cycle.
So time horizon, obviously very, very critical. Now, one thing that I think you track better than most is flows. You know, right? If we look at the picture right now, like what are capital flows telling you about positioning and risk appetite right now across asset classes? Because there's a lot of data coming in outside of equities. There's a lot of data coming in that seems pretty bearish, right? Even in the housing market, like it looks pretty saturated. And if you think about your boomer comment, it's like these people are probably not going to be staying in their McMansions much longer. Maybe they will. But what is the capital flow data that you track telling you right now about risk appetite across the key asset classes?
It's a mixed bag. It's a real mixed bag. So if you start with equities and if you look at the riskier stuff, the crypto spot, Bitcoin funds, and some of the growth funds and the like, there's been a big headlong rush to get into risky assets since the April 8th low, if we were to use that measure. But at the same time, there's also three categories of funds. There's T-bill ETFs. I'm going to use ETF flows because I think they're a good proxy. T-bill ETF, short-term duration, which is like a bond fund less than 3 years. An intermediate fund duration, which is like bond funds 3 to 7 years. Massively large flows. So the public is saying the market bottomed in April 8th. Give me the risky stuff because it's going to rally. Okay, I understand that. But then they're also saying, I want even more of the super safe stuff, like a T-bill fund as well. And so you're seeing them also rush into that. So it's all over the lot right now what they're trying to do. Are they trying to be defensive? And you see this on social media too. People are looking at the big flows into money market funds and say, oh, this is bullish. This is money. This is cash on the sidelines. It's going to be spent into the stock market. I've been in the market for 40 years. The first week I got into the market, I was told literally almost the first or second day of my first real market job on Wall Street, there's a lot of cash in the sidelines, and that cash is going to come out of the sidelines and it's going to buy stocks. And I've been waiting 40 years for that to actually happen. And the point I'm trying to say is it doesn't work that way. It's never worked that way. It's a nice narrative that this is potential buying the $7 trillion in money market funds. But the people that are in money market funds are basically the 70-year-olds saying, thank you, 4%. I'll take a 4% yield. It's more than inflation, and therefore I could sleep at night. And it's not going to wake up one day and panic and say it has to buy Tesla or Bitcoin or something like that. It just doesn't work that way, and it's never worked that way. Real estate is an interesting story because I've got a outside consensus view about real estate. People are looking at the real estate numbers and they're seeing mortgage rates are going up. The average mortgage rate for the average house right now is $3,100 a month. And they're saying that that's very high, correct? And that's why sales are down something like 30 or 40% from the peak. A lot of buyers can't afford the average house because the mortgage rates are up. And so therefore, a lot of stuff isn't trading. And on the seller side, a lot of people are trapped in old 3% mortgages because they refied in 21 or 20 at a 3.5% mortgage. And we don't have in the United States what's called an assignable mortgage. Some countries do have it. If I have a 3% mortgage on my house and I have $200,000 left to pay off and I sell my house, I can't transfer my mortgage to my next house and just keep paying that same mortgage. Other countries, you can do that. You can't do that in the United States. So you'd have to pay off that 3% mortgage and take out a new 7.5% mortgage. So people are trapped. Now, I would argue that something else is going on too, because I look at the Redfin data when it comes to housing. Now, the reason I like Redfin is they do a metric of home price per square foot. So they look at every multiple listing, how much is the house, how many square feet, and they do a home price per square foot. Mm-hmm. That is pretty close to the all-time high. The all-time high was only set in the last several months, so it's not that far off of it. So what I'm afraid of is everybody's saying, look, $3,100 a month is too much money for the average mortgage. Fed's got to cut rates or mortgage rates got to come down to lower that to get the housing market to move. And I've argued, no, it's not coming off of $3,100. Because if for some reason I'm wrong and interest rates come down and those mortgage rates go 7, 6.5, 6, and what'll happen is the sellers will just raise the price of the house and you'll still be back to a $3,100 mortgage is what you'll wind up. If mortgage rates go 7.5, 8, 8.5, they'll lower the price of the house and you'll still be back to a $3,100 mortgage. We're not going to come off that number. So if the complaint is that $3,100 is too much, and that seems to be the complaint, I don't think we're coming off that number anytime soon. The Redfin data has clearly shown that over the last couple of years, that home prices kind of adjust with mortgages so that the monthly home price doesn't move. And that's really where we're at with this market. So as I said, be careful of this. We need lower mortgage rates. Yes, so the sellers could raise the price and you're just right back to where we are today, and that we haven't really done anything at that point.
I think, I don't want to put words in your mouth, but you seem to be a believer that inflation is here for somewhat longer term.
Yeah.
Would that be accurate?
Yes,
okay.
And I can even give you a time frame on it too if you want.
Okay, I definitely will. Okay. Now, I have a couple things that I lean to with that perspective as well, but there's a couple headwinds that give me pause on asset values, which ties into inflation, and that is, number one, fertility rates. If we're talking more longer term, families aren't as big as they used to be, women aren't having as many children as they once did, and so forth. And then two, AI, both of which to me, I think there's arguments that they could be deflationary. Now, what's your take on fertility rates impacting asset values and therefore inflation, and AI? What's your take on that?
So I agree with you that I think the biggest single problem that the West faces is low fertility rates. It is a crisis in South Korea. I mean, they're going to effectively disappear with the unbelievably low. I mean, the country, if their fertility rates stay where they are now, the country will be half the size that it is in like 50 years or 70 years or something like that. But I think that is a big problem. Now, I'm hoping, in looking at some of the demographic data in the past, fertility rates tend to be cyclical. So that we're at a cyclical low. Yeah, they do. They tend to be cyclical. We're at a cyclical low and that they turn up. Various reasons why that could happen. But nevertheless, there is a baby bust underway right now. The Gen Alphas and stuff. That is going to put a pressure on home sales, no doubt about it, because, we're going to have to see what Gen Alpha wants out of life. Because the other problem we have to think about too is we don't know yet. What is Gen Alpha want? Do they want like the boomers in the 50s? Do they want the suburbs? Which means that densely urban real estate is going to be problematic because they're going to abandon the cities for the suburbs. Now, why would they do that? Well, maybe because remote work and things like that. I can get this job. I don't have to have an apartment, a 400 square foot apartment in, Hell's Kitchen on Manhattan. I could take this same job and I could live in, Vail, and I could ski because that's what I want to do and do this job from there. Or I can live in Fort Lauderdale because I like the sun, or whatever. Pick whatever you want. So I think that's going to be a problem for some housing, but I don't think we know what it's going to be. Do they want the suburbs like the boomers, or are they going to be more like Gen X and they want urban? Gen X, Gen Y, they really love to live urban. Or is that really what they want? Now, preferences change over time. So you could see that. Now, AI, I have a little different opinion about AI, that it's both deflationary and inflationary at the same time. And my thinking comes from Northwestern University professor Bob Gordon, who's written a lot about technological change. And to summarize what he says is technology is a net creator of jobs. That AI, and all of this stuff is going to be a net creator of jobs. And I'll give you one example that everybody uses. In 5 years, we're going to have full self-driving. In 5 years, we're going to have nobody having the job description of driver anymore, whether it's a taxi driver, a truck driver, tow truck driver, fill in the blank, a train conductor, whatever. It's all going to be automated. That's like 8 million jobs in the United States are going to go away. And that's going to be highly deflationary, is what you say. Well, if that's all that happened, That's correct. It would be highly deflationary. But as Gordon would argue, we're going to create new industries and new jobs, and there's going to be more than 8 million of them that are going to be created. One example, if you get rid of the driver, then the cost of transportation goes way down. It makes delivery of stuff much cheaper. It changes our lifestyle. There's going to be whole industries of stuff that we make, put in a driverless car, and it's delivered to you in 20 minutes or 2 hours or whatever. And it's going to be multiples of what Amazon is offering us right now. The problem is I don't know what that is. You don't know what that is. We don't know what that is. The example that I've heard Gordon say, when Steve Jobs held up the iPhone 1 in 2006, and he said, look, we've got this new thing, the iPhone 1. Raise your hand if you said, man, that's the end of the taxi industry. That's the end of the hotel industry. Airbnb is never going to be the same because of that. No, we had no idea that that's what was coming. And that's what happens with new technology. The new technology is going to create insatiable demand for these new things. They're going to be somewhat inflationary because they're demanded, they're wanted, they're going to be scarce because we want more of it. And so that's going to offset the deflation. The deflation argument comes in. What the deflation argument is, society, culture, the economy is exactly the same. Nothing changes. We just eliminated drivers. No, if we eliminate drivers, we've changed we've changed the way we live our life. Because if you eliminated drivers, you don't need to own a car. The future is you don't have a driveway, you don't have a garage anymore, you don't have a driveway anymore. There's going to be 50 million driverless taxis on the streets, and there'll be three or four every half mile away from you. Push a button on your phone, one shows up in 20 seconds, and you go do what you want to do, get out of it. Push a button, another one shows up in 20 seconds. That's how everybody's going to live their life, is they're just going to jump around in these driverless taxis, even if you're remote or not remote. That's the argument. And what that will do is that will change a lot of things. It will change so much of the way we live our life, and it will create demands for new products that we have not seen. And I'll give you one quick example from history. It has been used a lot. In 1979, VisiCalc invented the electronic spreadsheet, which then eventually was popularized by Lotus 1-2-3 and then Microsoft Excel, Google Sheets, and the like. And in the early 1980s, everybody said, that's the end of the accounting clerk. People that used to write numbers on pieces of ledger paper because we've got these electronic spreadsheets. And they were right. Over the next 10 years, like 70% of the accounting clerk jobs disappeared. But because we had the numbers on an electronic spreadsheet and we could put formulas on the electronic spreadsheet, we created a new position called financial analyst, that you could do something more than just write them down on a sheet of paper. You can analyze them, project them, recast them in different ways. We actually created more financial analyst jobs than we got rid of accounting clerk jobs. And those financial analysts were in high demand and got a lot of money. And so they had wage inflation where the accounting clerks had wage deflation. So there will be an offset to AI, whatever it is, because it will open up whole new industries and millions of jobs that don't exist right now. And there will be demand for that stuff in the future.
Interesting take. I have a lot of appreciation for that. So if you're an investor who's not dialed into, because I think AI is obviously very revolutionary. It is. I think it's going to change the world. That said, if you're an average investor at home, for me, I think the greatest or the easiest exposure to get to AI is to continue to invest in the NASDAQ, things like the QQQ. Like, I don't know how an average Joe can stay on top of all the daily machinations and changes within the AI space. So it kind of, to me, seems like you have to have exposure to things like the NASDAQ, no?
Yes, to a point. If you want to use the overlay with the internet from the, mid to late 90s, when we were really, I know the internet was invented before that, but that's really when it became popularized. What really made the internet take off is the decentralization of it. When it became something that I could start a website for practically no money, if not free, and get an email, put hyperlinks on my website, and I could create everything. I didn't have to go on bended knee to $1 trillion company and pay them huge fees to do it. That's when everything took off. But before that, you had to invest in, you had to buy AOL or Prodigy or, Yahoo in its early infancy, Lycos and stuff. These big, this is all pre-Google, by the way. These big companies, because that was the only way you can access the internet. It's when it became decentralized. And then you had, the startups like the Amazons of the world that were coming along. And a lot of those companies. Eventually in 2004, you got Google, which was a brand new startup as well, because they did not require this centralized force to give them access to these tools and they could use them. When AI becomes decentralized, I don't have to go pay, OpenAI $30 a month or $200 a month to get the latest, greatest. That I could actually create it myself. I could actually use it for free. I could actually create my own large language model with little to no programming for whatever I want it to do and give me the output that I want. That's when the true creative capacity of it will take off. At that point, investing in just the big Mag 7 NASDAQs will shift kind of like it did in the late 90s, early 2000s, to all the startups that started to come along and come down the pike. And we weren't thinking about buy Cisco, because I remember 99 when everybody said Cisco's going to be the first $1 trillion company. Still hasn't made it to $1 trillion. And we have a lot of other $1 trillion companies because everybody had to buy, the overused term on Wall Street is the picks and shovels. That's from the gold rush. The people that got rich were the ones that were selling picks and shovels. And Cisco routers were the picks and shovels of the internet. So you can't go wrong with Cisco. We actually did, because Cisco got overvalued and fell. And then when it became decentralized, all the money went to hundreds of little companies. Well, now the picks and shovels plays are the Mag 7, and they'll work for a while. But when it becomes decentralized, that anybody could start one of these things, then that's the true capacity that is unleashed on it. And that's when all of a sudden the picks and shovels plays start to struggle. And the last thought for you on this, that's what January was with DeepSeek. Why did the markets freak out so much about the DeepSeek announcement? Because they said, I don't have to be $1 trillion company. Because it was just a few months before that Microsoft announced they're going to build a data center in Pennsylvania and power it by restarting 3 Mile Island's nuclear plant. Oh, you mean I could start my own data center and large language model without buying a freaking nuclear power plant to power the thing? And anybody can do this. That's what that's what was so important about the potential DeepSeek announcement, is that we're going to take it away from, I don't need $1 trillion. I don't need, Stargate in order to make AI a reality. Anybody could do it. That's when the internet took off. When we get to that point with AI, that's when I think it take off. And I agree with you. When we get there, it will be more transformative than the internet itself.
That is that's a great take. And that's one of the first kind of, because I invest a lot in venture capital and stuff, and it gives me optimism, because I'll tell you right now, over the last 2 years, we've seen with a lot of these startups is they come up with this cool concept for AI, whatever it may be, LLM idea or image generation, whatever, it doesn't matter. 2 months later, it's not relevant, because the big players have so much capital that they're throwing into these 5 or 6 niches in the AI space that startups can't compete. They move too quick, right? But I do, you make a great point about that, and that gives me hope.
I think the idea between fully self-driving cars, my take, what's been holding it back? Because it was 2015 that Elon was saying, look, in 5 years, every car is going to be fully self-driving. Well, it didn't quite happen in 2020. We're closer in 2025, and now they're still saying it's going to be another 5 years. I think what it would take to really get to full self-driving cars is to flatten. You don't need to be $1 trillion company to try and start a fully self-driving car company. Anybody could do it. 3 guys in a garage with a good idea could do it. And when you get hundreds and hundreds and hundreds of these companies all competing with each other, the innovation curve just goes vertical. But when it's $5 trillion companies competing with each other, then the innovation curve flattens out. And then worse, I'm going to take a shot at Google. Google's long been known that whenever there are 3 guys in a garage that have a good idea that might threaten Google, they overpay to buy it so that they can just bury it within the Google empire, never to be innovated or seen again. And so if we could get to that really true innovation